Frederick Real Estate Network, and thanks for joining our webinar on financing for real estate investors. As you know, in the past 35 years of our organization, we have been heavily involved in real estate investments all over the country, and over 20,000 transactions have taken place through our organization, and many of those have utilized financing of some type. So, we know very, very well how important it is to understand financing, to bring you guys correct and updated information, and to work with the best lenders in the business. For the past 9 years, our organization has worked with Reed Hazard with the AmeriFirst financial team, and Reed is a very, very knowledgeable, very, very skilled mortgage lender, and he's also the branch manager. Reed's office is located in San Clemente, here beautiful Southern California in Orange County, and we've worked with Reed for the last 9 years. Reed has done, and he'll tell you in a minute, hundreds and hundreds of transactions with our organization. So when it comes to financing, most of you guys know that it's changed a lot over the last several years. So it's very, very important to stay up to date on lending guidelines, what the banks are looking for when qualifying for a loan, and then how you fit into the equation. Every person's different, and that's one thing that we found out over and over and over again, is that everybody's got a little bit of a financial position, how they're employed, how they receive their income, how they do their taxes, the amount of mortgages they have, their credit. All these things come into play when qualifying for a loan, and I really want to stress that if you're not sure exactly where you fit in, the best thing to do is contact a lender like Reed if you're not exactly sure. Reed can go over all the financials with you, and hopefully by the end of this presentation over the next 30 minutes you have a really good idea of how to qualify for a mortgage and what the banks are looking for, and hopefully you're very educated and stay up to date, and you can even tell other people and impress them with all the knowledge you know. So Reed is on the call with us, and he's going to talk to you guys about all the different components that go into qualifying for a loan, and there's really nobody better that I could that I could have on this call than Reed. We've worked with dozens and dozens of lenders, from Wells Fargo to Bank of America to the smaller lenders, and we found that working with a direct lender like AmeriFirst that specializes in investment mortgages is really the way to go. We've worked with many different large banks, and with all the different departments they have, all the different products they offer, things are just so corporate. It's very, very difficult to get things streamlined. But with a direct lender like AmeriFirst, they've got in-house underwriting, in-house processing. The transactions and the escrows are very, very streamlined. And it's just great to have somebody that has just excellent customer service. So Reed, I know I've talked you up quite a bit. Why don't you jump on the call and get it started?
Wonderful. Thank you for that, Scott. I really greatly appreciate the introduction. Hello, folks. How are you? I'm excited to be here this evening and discuss financing for real estate investors. So I'm going to jump right into the presentation. A little bit about myself. I've been doing investment property financing and financing in general for primary homes as well since 2004. So I've financed a lot of properties by this point. I bought my first investment property when I was 19 years old in Altamont Springs, Florida. I bought several since then, including my primary residence in Aliso Viejo, California. And also, I'm personally state licensed and federally licensed to lend in California, Texas, and in Arizona. Now, my branch is also licensed to lend in Tennessee, Indiana, Colorado, Washington, and a few other states. So get in touch with me after the presentation, and I can go over those states with you in further detail. Also, I'm specializing in doing 1 to 4 unit property. So the difference is that if you're buying a single-family home, a duplex, a triplex, or a fourplex, you will then qualify for what's called conventional financing, which is Fannie Mae financing. It's the lowest financing rates out there. Anything over 4 units is considered a commercial property and therefore has different financing guidelines. Okay? So the first question I've been asked recently is hey, Reed, what's going on with interest rates? I mean, they've been at all-time lows now for over 4 years. And when are they expected to go up? So many of you watch CNBC or watch Bloomberg and follow the markets and follow the trends. For any of you that don't, The Federal Reserve, about 3.5 years ago, started a bond purchasing program called QE, which is called quantitative easing. Okay, and essentially what they're doing is they're buying mortgage-backed securities, or rather mortgage bonds, through two large entities, which are Fannie Mae and Freddie Mac. Now, the government purchased 51% stake in both companies a few years back, and has, like I said, they've been buying mortgage bonds through those two companies, okay, to artificially create a market for low interest rates. Now, in January of this year, Janet Yellen, our new Fed chief, decided that it was time to start scaling back on what was an $85 billion a month bond purchasing program for the past 2 years straight. So they were buying $85 billion for over 2 years straight, and before that they were buying around $45 billion a month for almost 4 years. So in January, she decided that, hey, listen, it's time to start scaling back. Unemployment levels are getting better. GDP growth is getting better. If we don't start scaling back, we're going to start creating an artificial bubble in the bond market. So since January of this year, they've been tapering back by $10 billion a month. So $85 billion starting in January and $75 billion in February and so on. And by October of this year, they're looking to purchase their last $15 billion bundle of mortgage-backed securities and treasury bonds. Okay, so at that point, we're expected to see rates go up. Now, they're not going to fly up, and here's the reason why. The federal fund rate, which is the overnight rate at which banks have money lent to them from the Federal Reserve, is only a 0 to 1/4% right now. So that's the borrowing rate that it costs banks to have money lent to them right now. Okay, that rate is not expected to go up for at least 9 to 12 months after QE ends. Okay, and this is, again, guys, this could all even change, before October. If for some reason something over in the Ukraine or overseas gets worse, if unemployment levels start to trickle back in their direction, if anything happens between now and October that's not within the Fed's scope of what needs to happen for QE to end, then this will continue to go on further. But we've seen month over month economic data continue to get better, and based off of this month that we're in right now, August of 2014, we are projected to have the last purchase be in October of this year. So again, rates are expected to go up about 0.5% at that point. For every 1% rise in your interest rate is a 12% rise in your monthly payment. So for any of you that are buying for cash flow, which you all should be, it can greatly affect cash flow in a lot of the markets that we're doing property in. So it's very, very important to watch the markets, and that's why rates are so important. So again, the Fed taper is looking to scale back by October of this year. The new target for when the Fed is going to raise their federal fund rate is 6 months to 12 months after QE ends. And on a recent broadcast, Janet Yellen saying that it should at least be 9 months, so keep that in mind. And then again, this reduction in MBS, which is mortgage-backed securities purchases, is expected to push pricing upwards, but at a stable level. So another thing to look at as well is in 2004, 5, and 6, you could buy 10 investment homes with no documentation. Okay, it was a very, very loose lending environment, which is why we had this dramatic crash that we all experienced in 2008. Okay, since 2008, lending guidelines have been tightened. It's been like taking a blood sample to get a loan. Many of you have obviously experienced that. So understand that because of that full documentation lending environment that we've seen since 2008, the mortgage-backed securities, or the mortgage bonds that have been originated, are very stable bonds. The default level on those mortgages are very, very low, meaning that people make their payments when they get a loan. As an example, we've had to buy back one loan out of 1,200 over the past 12 months. Okay, and that was an FHA mortgage. It was not a Fannie Mae or Freddie Mac mortgage. Okay, FHA is for a more high-risk borrower, and it's not for investment property financing. Okay, but to put that in perspective, there is a very, very, very low buyback for doing conventional mortgages in this day and era. And for that reason, mortgage-backed securities or mortgage bonds are highly sought after from an investment standpoint because of their low default rate and because they pay a higher yield than Treasury bonds do. For instance, look at the 10-year Treasury note. It pays on average 2.5%. The mortgage-backed security pays on average 3.5%, okay? And again, has a very, very low default. So for that reason, investors do park their money into mortgage bonds, and it's very, very likely that after the Fed backs out, you will see investors purchase these mortgage-backed securities at close to the same level that we're already seeing now. Okay, for that reason, we're not expecting rates to fly up when QE ends, and for that reason, we're also not expecting rates to fly up above the 7% range after the federal fund rate starts to be raised. And remember, the federal fund rate affects all types of borrowing, okay, from business finance to mortgage finance to auto loan finance, credit card finance. So again, that's the rate you have to keep your eye the closest on. Now, to jump into how we actually get you qualified for financing in today's market, okay, debt to income ratio. Everybody should understand what this means, okay? That's your monthly debt, okay, so your monthly revolving debt. So if you were to run your own credit report, okay, or if you were to have me run your credit report, whatever debts are tied to your Social Security number that are going to show on your personal credit report, okay, if it's a credit card that has a $4,000 balance, we're not going to count $4,000. It's whatever the minimum payment is, okay? So payments that show up on credit, which would include auto loans, mortgages, which include property taxes and insurance, student loans, any other loan that's on credit, okay, we're going to take all those monthly payments, and we're going to divide that into your gross, which is your pre-tax monthly income. So example, you make $10,000 a month in pre-tax income. Your monthly debts are $4,000 a month. $4,000 divided into $10,000 is 40%. Your debt-to-income ratio would be 40%. Okay? Debts that do not count against the debt-to-income ratio include the following: auto or health insurance, cell phone and utilities, which would obviously include cable, loans to family or friends that are not recorded, and business loans. Okay, so anything that's not showing up on your credit report, we do not have to count, or anything that is not able to be found through the county. And I'm going to be going over here shortly what the max debt-to-income ratios are in order to qualify for investment property. Okay. I work with a lot of real estate agents and brokers here in Orange County and even up in Northern California. And one thing that we notice is that for every client that I can send to a real estate agent that's looking to buy a home that comes to me first, a real estate agent will have 5 clients to send back to me. And the reason why is because most people do not look into what they can get qualified for, or rather do not look to get pre-approved for a home loan until they've gone out into the market and seen what type of properties are available, which is understandable, okay? But it's very, very important that you don't get pre-qualified, that you get pre-approved, okay, if you're going to use financing before you go out and shop for real estate. The network will definitely want to see that you have a way to buy property, whether it's buying property out of a retirement account, which would not utilize conventional financing, or buying all cash, or buying with a partner, or in my case, if you're going to buy with a conventional loan, they do want to see that you're able to get qualified. So in order to get qualified to buy a home using Fannie Mae or Freddie Mac financing that have the lowest rates, here's what you need to do. You take an application over the phone, or you can go to my website, which is www.reedhazardloans.com. You click on the Apply Now tab and complete the application. We would then need to run your credit report. Credit is pulled through 3 bureaus. You have TransUnion, Equifax, and Experian. Okay, we always go off of the mid FICO score. That's what we're going to be qualifying you off of. Okay, we then would run your credit and your application through what's called an AUS. That's an automated underwriting system. Okay, so if the loan's going to go to Fannie Mae or if it's going to go to Freddie Mac, depending on the FICO scores and you know, just you as a borrower, whatever we can get the best pricing on, we would then run it through their automated underwriting system and make sure that we can get you approved ahead of time. It will then give us about 10 pages of documentation, things that we need to point out. We will then follow up with a specific documentation needs list. Okay, W-2s, pay stubs, tax returns if they're needed on the transaction. You would get those supporting documents back to us. My assistant Kendall and I would then submit your loan into processing. Okay, the processor Josh Farella will submit your loan to my underwriter Lee Tiska. Okay, after we have what's called verification of employment and a few other documents, Lee Tiska will then review your file and give it a pre-approval. Now, I've been in this business for over 10 years. I've stayed in it for the entire 10 years. I've never left, and I have seen guidelines change dramatically. The one thing that I can always tell people is that until your loan has been reviewed by an underwriter, you have nothing. Okay. If you make $500,000 plus a year, you own no rental property, and you've got a 780 mid-FICO score, it's pretty obvious that you know you can get qualified for something like this. Okay, so we can do a light pre-approval over the phone. But in many cases, investors have multiple partnerships, or they have maybe a Schedule C company showing on their tax returns that they're writing some stuff off on. You may have multiple rental properties. Okay, there's a lot to be looked at here. So you need to have your file reviewed by an underwriter. That's how we do pre-approvals here at my company. Now, some of you may have gotten pre-approved through other companies in the past, and things went fine, and they only took an application or pulled your credit up front. Again, for most cases, a lot of the horror stories that I hear about, it's because it was just not done properly up front. You got to get a proper pre-approval. So some things that you definitely want to do, if you already have your own lender, is you want to make sure that they've gone through the process that I just laid out in front of you. Many of you have just gotten the application taken, credit report pulled, and then the AUS ran. That's not a pre-approval. That's a pre-qualification. Okay, now how to close your loan faster. The things that I've mentioned here on this slide are not things that you can't do. They're things that we would prefer you not to do after you've gotten into the loan process, found a property, and we're processing your loan to close it within 30 days. Okay? Don't apply for or open up new credit of any kind. So don't go and get a new auto loan or a new credit card while we're in process, because it will affect your debt-to-income ratios, and we'd have to put the loan back into underwriting to have it underwritten with correct ratios. Also, in many cases, if you already have very tight debt ratios and you go out and you purchase an automobile that has a $400 a month payment, it may throw your ratios up above 45%. We may not be able to get the AUS approval through our underwriting system, and now you have a dead deal. Okay? The cost for ordering an appraisal for investment property is over $600 because we have to get the appraisal and what's called a rental comparable analysis, which is an additional $200 to $250 depending on the market. We don't keep those fees. We order through an appraisal management company. It's a Fannie Mae approved company, and they find the appraiser for you. And Fannie Mae is obviously the one buying the loans, right? And they're the ones that make sure that we have the rental comparable analysis. Therefore, again, $600 plus to order an appraisal. That's why it's so important that you follow these instructions very, very clearly if you have tight debt ratios, so we don't have an issue where your deal falls out mid-escrow. If you're going to open up new credit of any kind throughout the loan process, contact your loan officer first. Make sure that the debt ratios work out with the new monthly payment. That way you safeguard yourself. Secondly, don't max out or overcharge on any of your current credit cards. Very important that you know if you're using over 30% of your available credit every month and letting that revolve, anything over 30%, it will slowly bring down your credit scores. If you're allowing yourself to use above 75%, it will bring down your scores dramatically on a monthly basis. Credit recycles every 30 days. So a lot of times, by just paying down your credit card debt below 30% of your available usage, you can improve your scores 50 to 75 points within a 2-month period. Thirdly, don't consolidate any credit card debt. You don't need to do it throughout the process unless we tell you. Don't make any large purchases. Again, that could be a $5,000 purchase or $6,000 purchase. If you're going to go make a purchase and you're going to buy with all cash, and it's not going to affect the cash to close, meaning that it's not going to dip into down payment funds or closing cost funds, then we're fine with that, but you should still run it by your loan officer just to be safe. Also, don't make large deposits into any of your accounts. Let me explain this to you. We have to source funds for down payment. We have to source funds that are coming into your account randomly via check. The reason why is that the underwriter for the account that we're using for the down payment closing costs, the underwriter is not allowed to approve any funds for down payment or closing that are not sourced and that are not your own funds. The reason why is that you're not allowed to use borrowed funds for down payment on an investment property purchase. The only type of borrowed funds that are allowable are from a home equity line of credit that you have attached to one of your other properties, either a primary residence or an investment property. Those are considered borrowed funds, but they are allowed. If you're going to buy with an investment partner, I don't need to know about that, but the best way for you to do that, if you're going to use their funds for down payment and closing, and you're going to use your credit to qualify the transaction, is you would have them place the funds in your bank account, let those funds season for a few months. That way when I get your loan file, they are your funds, and that's how we'd be able to close a transaction. Also, just lastly, this had happened to me in the past. I was doing a loan for a bartender, and I had pre-qualified him up front with everything but his bank statements because he assured me he had $45,000, which was what was needed, and he was trying to put in an offer, so I got him over the pre-qualification letter. When it came time to get his bank statements, he had a $45,000 cash deposit. It was because he had been saving about $1,000 a month from his job, from bartending for over the years. And I was unable to do the deal because the underwriter does not know where those funds came from. Okay, this is for an investment property purchase. If it was for a primary home, we could have said that they were gift funds. But again, it killed the deal for the fact that we don't know where those funds came from. We don't know if it's drug money. I mean, there's really no way to tell. So it's very important to prepare yourself correctly if you're going to be depositing cash or funds from an area that can't be sourced, and that we have 2 clean bank statements not showing those deposits being made. Things to do throughout the loan process in order to keep it very, very streamlined and quick: do maintain employment at your current job. Do keep all existing credit card accounts open. Do pay off collections, judgments, or tax liens reported within 1 year. And do stay current on all existing accounts and financial documents. Now, I'm going to outline a few things over those 4 that you need to know. When I say do maintain employment at your current job, if you're a W-2 employee and you're changing jobs in the same line of work to another W-2 job, I only need 1 pay stub from the new job, and then we can close your deal. If you're going from a W-2 job to a 1099 job, like for instance, you're a doctor and you just got partnered and now you're making $275 a year as opposed to $150, you may think that that makes you look better, but in fact, it would keep you from being able to qualify. The reason why is when you go from W-2 to 1099, you're now a self-employed borrower. We need to see 1 year's income tax returns to show what your write-offs will be before we can qualify you. So, again, very important that if you qualify based off the job that you're already in, stay at that job for the 30-day period until we close your deal. It's the easiest way to do it. Also, if you do not stay current on all existing accounts of financial documents, for instance, you miss a 30-day payment on a credit card, it will drop your credit scores nearly 100 points. Very, very important stuff to just stay current on everything. Okay, so you got you fully pre-qualified, or excuse me, fully pre-approved, ready to go, right? You find a property, you're stoked, you put in the offer, we've got a signed purchase contract, okay? Here's what we're going to need from you. My assistant, Kendall Brown, will take the transaction from here all the way to closing from a documentation standpoint. But just so you know what we're going to need up front, a copy of the earnest money check, because you're going to have to deposit some funds into escrow for good faith. That'll probably be about $1,000 on average for a $100,000 sales price. An updated bank statement for the account you'll be using for down payment and closing costs. Escrow will then open. The loan is officially disclosed, and what you will receive at that point are preliminary loan disclosures, a good faith estimate, and a truth in lending disclosure. The good faith estimate lists an estimate of all the fees on the transaction. The truth in lending disclosure discloses what your APR will be. That's your annual percentage rate. Please know that neither of these will be accurate when we disclose, because we have to disclose all fees high. My lender costs do not change, and I do my loans with no points. However, the third-party costs like title fees, escrow fees, notary costs. On a purchase transaction, the seller chooses those companies. So we don't know up front what those fees are going to be. We have a good idea, but we have to disclose those fees high, because in the event that those fees come in higher than where we disclose, the bank has to eat the difference. And that's a new law that went into effect in 2010 and is part of the Frank Dodd Financial Reform Bill. Okay, so just know, again, not to confuse you, when you get those initial loan disclosures, all third-party costs will be an estimate. We will then request, though, the day that we get your purchase contract, we will request an estimated HUD closing statement from escrow. The estimated HUD closing statement will have a very accurate idea of your total cash to close. It will show how much money you need to bring in for down payment. If you're setting up an impound account to pay your taxes and your insurance with your monthly payment, you're going to have to deposit some funds into escrow at closing, which will go to the lender. So it'll have that on there. It'll have the exact third-party cost for title and escrow fees. It will have my lender fee, and it will also show any lender credit that we have negotiated based on your rate and fee. And my assistant put on this slide for me, very important, remember to sign and return the initial disclosures documents immediately. So yes, everything is done via DocuSign, so you can do it all over the internet through your email. If you have any trouble doing that, or if you would like us to send out a complimentary UPS document package for you to sign and date and get back to us. We can do it that way as well, whatever's easiest for you. The next steps would be the appraisals ordered through an AMC. Now, what is an AMC? An AMC is an appraisal management company. Okay, we have to order all of our appraisals, whether it's a Fannie Mae Freddie Mac loan, which is any loan size under $625,500 here in Orange County, California. Out of state, in most states it'd be any loan size under $417,000. Okay, we have to order through the AMC whether it's a Fannie Mae Freddie Mac loan or you're buying a home here in Orange County as a primary residence and the loan amount's $1 million. All lenders nowadays make their originators order appraisals through an appraisal management company. The reason is that the lender on the back end that's buying the mortgage wants to make sure no one has influenced the value, meaning that the loan agent hasn't called the appraiser and said, hey, really need to get this value. The real estate agent has not done so. That appraiser has not been affected by anyone. And what's good for you is that we like to use something in the network called Trust But Verify. This is a way for you to trust us, but you are getting your appraised value verified by a local market appraiser that lives in that city and appraises homes regularly in that city. That way you know when you get your appraisal that it is at fair market value. Okay? Once the appraisal report is received, which we let's just say that we order on a Monday, we should have it back by Friday. So it's in about five business days or less. Once we receive the appraisal, the loan is reviewed by processing staff for submission, and then it goes into final underwriting. We should have that done within about 24 to 48 hours. The loan is then approved with conditions. Now at this point, Kendall will reach out to you with a list of anything else that we need from you in order to get what's called the clear to close. Okay? At this point, we're also going to be issuing the final HUD closing statement. That way you know, okay, I want to get my funds wired into escrow ahead of time, or at least want to get all my funds ready. Some of you may be selling off stock from a mutual fund account or whatnot and moving those funds into escrow. So you want to be prepared. So we'll definitely give you those figures within about a week of closing. That way you guys are all prepared to wire in your funds to close, and you have an exact idea of how much you need to wire in to close. Okay? So once the final clear to close is issued, docs are drawn by Holly Boyle, who's my doc drawer and my funder, and then I'll be sending off that estimated HUD to you, which you and I can both review before I release documents to go out to the notary and to the escrow company. Okay? At that point, we will make sure that everyone's on the same page, everybody's happy. That way when you're signing your loan documents with the notary, you don't have any hiccups. Okay? Now, also, if you're buying a home out of state, like let's say that you're buying in Austin, Texas, we're not going to have you fly out to Austin, Texas to sign your final closing documents. Okay? We're going to have a notary come to you at your place of business or at your home. They can come as late as 9:30 at night if they need to. You'd sign documents with them. It takes about 45 minutes to get that done. I'll be available while you're signing if you need me. Then documents, depending on when you sign during the day, will be FedEx back to the escrow company. Escrow company will then send the documents back to my funding department, and my funder will fund the same day that they get back your documents. Okay? We do need to have all funds to close wired into escrow prior to funding the transaction. And then you're a homeowner. Okay. I love to show this chart. I wish it went all the way to 2014. Unfortunately, it doesn't. Just to kind of point out how historically low rates really are. I mean, obviously, you know, you hear about it every single day. It's a great sales pitch, whatever. But I'm not using it as that. I'm an investor myself. So from a personal standpoint, when I see stuff like this, it's very exciting. I mean, take a look at back in the early 80s. I mean, actually, in 1983, rates hit almost 19%. Now, my dad was actually buying property back then and told me that literally he paid 18.5% for a mortgage loan. Now, remember, everything's relative, though, to its environment. CDs were also paying 18% back then. Okay, right now a CD is paying 1.25%. So everything's relative to its environment. But just put that in, put that into perspective. A 30-year fixed mortgage at 18%. Today, you can get a 30-year fixed mortgage at 4.625 to 4.75% for an investment property. Okay, you can get one for a primary home at 4 1/8. So these rates are not going to last long, as we know, and as they edge up, it's going to be reducing your cash flow, as you can see here on my next slide. You know, for every 1% rise, it's a 12% rise in your monthly payment, which greatly affects cash flow. Okay, now the down payment requirements to get a conventional mortgage for an investment property, I want to point this out first. For borrowers that own a primary residence or own any property right now, okay, every property that you own is considered, that's financed with conventional financing, is considered one finance property. You could have 5 loans on one property, and it's still only going to count as one finance property. Okay? For borrowers that have 4 or less finance properties, okay, the guidelines are as such. You can purchase a property with 20% down minimum and with a minimum FICO score of a 680. For a primary residence, you could go as low as a 580 mid-FICO score with 3.5% down. Okay, but for investment property financing is what we're talking about here. For a 2 to 4 unit property, so it's a duplex, triplex, or fourplex, minimum of 25% down with a 680 mid-FICO score. Now, if you already own 4 finance properties and you're just trying to refinance one of them, we want to see that you have at least 25% equity if it's an investment property. So if you have 75% equity in your investment property and you want to pull some cash out, you could cash out all the way up to 75% of what the value is. Okay? But if you already own 4, you're not able to buy a 5th with only 20% down. Again, 5 to 10 finance properties, which you see here below, it has a little bit different guidelines. You have to put an extra 5% down for each scenario. So 1 unit would be 25% down minimum with a minimum FICO score of a 720. A 2 to 4 unit property would then require 30% down with minimum FICO score of 720. Good thing is the rates are the exact same. There's no difference in price. Now, what are the debt-to-income ratio requirements for investment property? The general requirement is 45%. Now, I put on here what are compensating factors. How can they help me if my credit score does not offer a potential score improvement? Compensating factors are as such. Let's say that your debt-to-income ratio is a 49%, but you've got $500,000 liquid in the bank, okay, and you have a very stable income, or you're self-employed and your business has been around for 20 years, and you've got a lot of money inside of a business account, and you have strong assets, and you have strong credit, but you just have high debt ratios. I've gotten these approved through our AUS system. Remember, that's the automated underwriting system, to as high as a 49.99% debt-to-income ratio, okay? But as a rule of thumb, we like to state that 45% is going to be the max. Now, how can they help me if my credit score does not offer a potential score improvement? Now, that is referring to, we have a software, okay? We are not a credit repair company, okay? But we are able to give you advice on what you can do to improve your credit score based off of a 30-day scoring. What that means is that, let's say that I run your credit and I see on there that you've got 3 credit cards that all have a very, very high balance, right? You're using $9,000 a month and the limit's $10,000, okay? And you have no lates, though, and your credit score is a 665. I will have Kendall run a credit analyzer through our credit company, which is Cisco, and they will then come back to us and say, okay, pay down this debt by this amount, and this is how much that your scores could potentially improve. Okay, you can actually see this on page, depending on how long that your credit report is, it's generally either page 5 or page 8 of the credit report. You'll be able to see Experian, potential score improvement, 45 points, Equifax, yada, yada, yada. So it'll show that on there even for you. In many cases, you guys, you can really get your loan pricing a lot better too. For most of you that don't have lates, but you just have higher revolving credit card debt, we will then run this, tell you what to do. After you've paid down your debt, we order what's called a rapid rescore. It's free for you. It takes about 5 business days. And we'll actually rescore your guys' credit with the 3 credit bureaus and get you new scores. A quick example, I had a gal, 683 mid-FICO score, was buying a single-family home in Austin, Texas for $145,000. She was only putting 20% down, so her rate was a little bit higher than going 25% down. She was at about a 5.125 rate because of the mid-FICO score, and she was paying a half point. We got her scores up, okay, within 2 weeks to a 709 mid-score. She had to pay down $1,600 in debt. Her new loan pricing was a 4.875% with no points. So she saved about $650 in lender costs because of the points that she didn't have to pay anymore. And she also saved about $24 a month on her monthly payment. So very, very helpful stuff. It's free to you. And again, if you don't point it out, I'll point it out to you, because I always want to do the best that I can to get you the best deal possible. Oh, great. Okay, so our new website is fantastic. Any of you that have not been on it, I'm going to just pull up a slide here from the actual website itself. This is the Marshall Reddick website, okay? To analyze investments, okay, you're going to go click on investments, So we'll take you to our Properties tab. And I want to show you where you can actually pull up the numbers based on if you were to use conventional financing. Remember, if you're going to use Fannie Mae financing. So let's use 14102 Volpe in San Antonio. This is a fourplex. You're going to click on the property. Okay, you're going to scroll on down here. You're going to go right where it says Show Financials. Click on Conventional Financing. Click Show Financials. And there you go. So I come on here, I update rates depending on the market every week on here. Okay, and I track the market very, very closely. Okay, so depending on what the market's doing in the week, for instance, if you were to lower the rate to 4.625, everything down here adjusts. So it's just a fantastic system that they've set up here on the new website. Okay, again, investments, click on the property, click on Show Financials. If you're going to do a cash deal, it shows it. Conventional financing, it shows it. And then any adjuster that you make will adjust the monthly and the annual returns down here. Oh, some frequently asked questions. Very important stuff here, you guys. So you guys are doing your own debt ratios, right? You're finding out what your debt-to-income ratios are. You're going, gosh, I'm already at 44%. How am I able to add $1,000 a month onto my debt right now by buying an investment property? It's not going to work. Here's how you do it. We can use 75% of the gross rental income, okay, to offset the new monthly payment. So example, the property rents for $1,000 a month. We can use $750 a month to offset the new monthly payment. For properties, a lot of these properties not only pay for themselves, they'll actually add another $75 or $100 onto your income to bring down your debt ratios. We only count, okay, taxes, insurance, and principal and interest. We're not counting any management fees that you're going to pay for having your property managed or anything like that. So again, most of these properties pay for themselves or even add income onto you. If you're buying a fourplex, I mean, in many cases you can add another $600 a month onto your income by buying one. I have school teachers in the network that have bought up to 10 properties that only make around $5,500 a month because they have immaculate savings, fantastic credit, and they've been able to use these exact same qualifying guidelines to buy property over the past 5 years. Now, how do you factor the rental amount if the home is not pre-leased? I went over this a little bit earlier. The Form 442 is ordered with your appraisal, okay, and that's going to verify the local market rents. If the property is already pre-leased, we still got to get the 442 to be added in the file, unfortunately. But the good thing there is again, guys, trust but verify. You're able to verify what local market rents are. No one's just telling you. We're not just having our property managers tell you what they are. You're able to see from an appraiser that's local in that market 5 to 10 other properties within a 2-mile radius that are renting out for close to what your property is renting out for. So very good stuff. Okay, this is me at age 19. So again, guys, trust but verify. I mean, there's me doing the same exact thing that I do today. Very, very excited to be in real estate. I have a true passion for it. This is me when I was at American Direct Mortgage. This is me and my team today. Our offices are down here in San Clemente, California, right here towards the end of Orange County. This is my office building, the old historic City Hall building, right on the top of Del Mar Street. So any of you that are familiar with San Clemente, please stop on by anytime. I'm always available. Love to have you on down at the office. This is my beautiful team right here. This is my partner sitting next to me, Al Rodriguez, and we have our own marketing manager as well on site that can help out any of you that are real estate agents to help you build your own business as well. Just a little word of caution. I'm going to be ending here in just a second, but just on a purchase transaction, very, very important. Do not use a broker or a retail bank for many, many reasons, but the biggest reason is that they don't have complete control of the file. Okay, retail banks, you know, you may have an underwriter working on your file that's in Ohio, right, but you're doing your loan here in California. They're very, very disconnected. All of my team is in-house. They only work on my files and my team's files. I have complete control of the entire transaction. And remember, when you're using a broker, they're not funding the loan in their own name. How we have complete control of the file is we're a direct lender, right? We're the direct source of the money. So we're lending the money to you directly. We're going to fund your loan in AmeriFirst's name, and then we sell your loan to the investor on the back-end market, whether it goes to Fannie Mae, Freddie Mac. If it's a jumbo loan, maybe it goes to Chase, okay? So that's why it's so important to use a direct lender. Is they're the direct source of the money, and everything is done in-house from processing, underwriting, doc drawing, all the way to funding. And that's my contact information right there. So yeah, I'm the branch manager. Love to speak with any of you at any time. You can always reach out to me via email if you'd like. My website's right down there on the bottom. And yeah, that's gonna conclude it. Scott, are you there?
I'm here, man. You did a great job, Reed. And I know I forgot to mention in the beginning that not only do we refer Reed and have all of our investors talk to Reed when they're looking at qualifying, I myself personally had Reed help me purchase my very first investment property back in 2008. And at the time back in 2008, we worked with, Reed, you remember, over a dozen different lenders.
Oh yeah.
Yep. And just I had my pick of any lender I could work with, and I felt like, when I didn't really know Reed too well at the time back then, but I felt like Reed really was there to answer all of my questions, take the time with me to explain the process. I didn't feel rushed working with him. He said, "Don't worry. Whenever you're ready, I can answer all your questions." And I think that really holds true today still. And that's one of the things that you'll notice in working with Reed is that he's very thorough. He understands that real estate investing is not a 9-to-5 type of situation. And sometimes people send emails late at night. Sometimes people need to talk on the weekends. And one of the things I've realized is that when you're buying a property and you're in that escrow process and you've got a loan going, it kind of becomes the priority of your life. It's like move everything else aside, and hopefully you're not planning a baby or a vacation during that period.
Right.
I'd really plan around that if you do. But everything kind of becomes second to your investment in this process of buying a home. And when you need somebody, you really need somebody. When you need to talk to somebody, you don't want to wait a couple days to hear back. And Reed's customer service is phenomenal. So he takes pride in what he does. He's very, very good at it. And Reed, I thank you for being such a strong proponent of the network, for helping so many members. And I encourage you guys, if you're watching this presentation and you're not sure exactly where you stand financially, if you're not sure exactly where your credit situation fits in, give Reed a phone call or send him an email and set up a time to talk to him. He'll spend the time with you to answer all your questions. And like he said earlier, he's licensed in 5 of the top markets that we're located in, including California. So if you're looking at purchasing a primary residence, outside of your investment properties, Reed can certainly help with that too. And yeah, Reed, thank you so much. I appreciate the time you've spent, and thank you everybody for watching the presentation. And let us know if you guys have questions. Thank you.
Thank you. Bye.